Joining us today, BMO Wealth Management Chief Investment Officer Youngyu Ma is with us. Youngyu, it's great to have you. Talk to me about where you see the landmines in the second half and sort of ladder them up, if you can, in order of importance.
Yeah, we do think it's starting to be a show-me market. The market really needs to see data come in well now so they can have confidence the Fed doesn't need to tighten excessively from here. And as you're talking about, we do think that's the biggest risk right now, that if the Fed has to ratchet rates up, it's talking about two more times, but two more times is just a current baseline. And so far, the Fed has been surprising to the upside. So if that continues, that would be very difficult for the market. So certainly the inflation data, the expectations for what the Fed is going to do, if wage growth is going to be a problem, and even things like the 10-year Treasury yield, which looks like it's breaking out here, could add some pressure to risk assets. So there's a lot right now that needs to come in reasonably well in terms of data to calm the markets and to get it on better footing, including the earnings season, which you talked about. So it's really a very data-sensitive market right now, we think.
Yeah, and that leads us, bank earnings starting on Friday. A lot of people have been already watching what's happening to bankruptcies, delinquencies, the expectations for both loan loss and loan loss provision. Do you think that's going to be reflective of the environment you're talking about beginning Friday?
It is. Certainly people are going to focus on those things. And one big question is how much credit in the economy is going to contract. And some of those markers that you talked about will imply how much banks might be pulling back. And that, again, it could be a bigger concern if those numbers are larger than people are expecting. So, again, it's going to be very much data-driven, and people are looking to see right now in the context of when we've had strong economic data, if there's too much that's pointing in the direction of tightening credit conditions, the Fed having to raise rates too much, and this idea that a soft landing, which we've been talking about and promoting for quite some time, we might be a little bit too complacent, or market participants might be getting a little bit too complacent about this, given how much the Fed is looking to raise rates here.
What have we learned about the credit situation? I mean, it'll be really interesting to start getting the bank results. But that was the fear, right? Both at the Fed and for the markets, that we would get a more pronounced credit crunch. And we don't say it's not necessarily happening, right? Because we've seen signs of it happening, and we don't know what those lags really look like.
Yeah, it takes a while to play out, and I think the reality is we don't know. And it's two-pronged, right? It's partially on the side of lenders, but also on the side of borrowers. And borrowers looking to pull back or not being able to commit the resources that lenders are requesting for certain projects or for certain expansions. So this is something that takes some time to play out, and you really have to sort of read into certain data points as they come, and we don't quite know how pronounced it will be. So far, the indications are not severe, but again, it's something that remains a risk out there in the marketplace, especially as the Fed is looking to raise rates here in July, and as you talked about, maybe again in September or future meetings.
One of the big talkers last week was some of the prices paid metrics within the ISM surveys, both services and manufacturing. And some of the work that came out of it was that it's reflective of environments, at least in the past couple of decades, where CPI growth has been even flat. I wonder if you think we're overdoing the read-through on those.
Well, we do think that forward-looking indicators for inflation look relatively good, but we think that takes time to play out as well. And the question is going to be, can the data come in quickly enough that gives the Fed confidence to ease off a bit, or at least pause and maintain the status quo in the coming months? Or does that just take more time to play out? And is the Fed a little bit impatient, wanting to bring inflation down more quickly than it's coming down in a natural way? So there are a lot of questions here, because the dynamics could take longer than people are thinking, and longer than we've originally thought they would take. And there are some indications that the Fed is a little bit impatient here and wants to bring inflation down more quickly.